Hello, we are Team 7 and today we are going to discuss the topic role and impact of fiscal and monetary policy and exchange rate policy. First of all, let us see what is a fiscal policy and what is its role in an economy. Fiscal policy refers to the use of government spending and taxation powers to influence the economic activities. It involves decision making regarding how to spend money on various activities and also how to collect taxes from businesses and individuals so that government can ensure that it contribute towards the economic growth of the nation by influencing the aggregate demand, output and employment. Now, let's see the various objectives of a fiscal policy. First one is achievement and maintenance of full employment. Fiscal policy aims to ensure that all the available resources are utilized efficiently. By adjusting government spending and taxation, fiscal policy can stimulate economic activity during recessions and thereby create jobs and reduce unemployment. Second one is maintenance of price stability. Price stability means keeping inflation within a desirable range. So fiscal policy can influence inflation through government spending and taxation. During the period of high inflation, it reduces the public expenditure and increases the taxes so that it can decrease the demand and thereby help to stabilize the prices. The third one is to accelerate the economic growth. Fiscal policy plays a critical role in fostering a long-term economic growth and development by allocating resources to infrastructure, education, healthcare and technology. Government can enhance the productivity and innovation. And the last one is to reduce the economic inequalities by redistributing income and wealth through progressive taxation and targeted government spending. There are two types of fiscal policy. First one is expansionary fiscal policy and second one is contractionary fiscal policy. Expansionary fiscal policy is used to stimulate the economy, especially during the period of recession or economic slowdown. It involves increase in government spending and decrease in taxes. This is to boost the aggregate demand, encourage the spending and thereby reduce the unemployment. For example, government might invest in various infrastructure projects and also may provide a reduction in tax in order to increase the disposable income of individuals. And the second type of fiscal policy is contractionary fiscal policy. Here, government focuses on reducing the government spending and increasing the taxes. This is to control inflation when the economic growth is too rapid. Here the government aims to reduce the aggregate demand. For example, it might reduce the taxes so that it can it might increase the taxes so that it can reduce the amount of money which is circulating in the economy.
So coming to the next topic, the impact of fiscal policy. I'll be first discussing a case study, that is the US economic stimulus during the 2008 financial crisis. During the 2008 recession, the US government took strong action to stabilize the economy. It passed the Emergency Economic Stabilization Act in October 2008, providing $700 billion to buy troubled assets from banks, which helped restore confidence in the financial sector. In early 2009, the government also introduced the American Recovery and Reinvestment Act, injecting $831 billion into the economy through government spending and tax cuts. This money supported infrastructure, projects, education, healthcare, and provided tax relief to individuals and businesses. As a result, economic growth resumed and unemployment, which peaked at 10% in 2009, fell to around 4.7% by 2016. Although federal debt increased, the measures were crucial in reducing the recession's impact and aiding recovery. As we know, fiscal policy refers to how the government uses its spending and taxation powers to influence the economy. Let us dive into some key areas where fiscal policy has a crucial impact. Economic growth. The government can influence how fast the economy grows. By increasing spending or cutting taxes, it can boost economic activity, especially during tough times like a recession. On the other hand, if the economy is growing too fast and causing problems like inflation, the government might spend less or increase taxes to slow things down. Second one is employment. Fiscal policies can create or destroy jobs. When the government spends money on projects like building roads, it can create jobs and help reduce unemployment. Conversely, if the government cuts spending, it might reduce the number of jobs available because businesses might cut back on hiring due to lower demand for their services. Inflation. Inflation is when prices go up. If the government spends a lot of money, it can increase the demand for goods and services, which might lead to higher prices. To control inflation, the government might cut spending to reduce demand and keep prices stable. Next, we have income distribution. How income is shared among people can be influenced by government policies. Progressive taxes where higher earners pay more and social welfare programs which help lower income people can help reduce income inequality. Without these policies, the income gaps between the rich and the poor can widen. Taking an example, Scandinavian countries use high taxes on the wealthy and provide generous social benefits to reduce income inequality. Business investment. The government can encourage businesses to invest in new projects by offering tax breaks or subsidies. For example, tax credits for research can lead companies to spend more on developing new technologies. If these incentives are reduced, businesses might cut back on the investment. Consumer confidence. When the government helps people with extra money or tax cuts, it can boost their confidence and thus increase their spending. This increased spending can help the economic grow. Last, we have global influence. What happens in one country can affect others. For example, if a large country like the US spends a lot of money, it can lead to more demand for goods from other countries benefiting their economies. On the other hand, if a major economy cuts spending, it can reduce demand for imports from other countries which can impact their trade and economies.
So next we are going to talk about role of monetary policy. So first of all, what is monetary policy? So in simple words, a monetary policy is a set of actions to control nations' overall nation's overall money supply and achieve economic growth. So there are five level roles of monetary policy. The first one is controlling inflation and controlling inflation. Firstly, inflation is the rate at which the process for goods and services which rises. So if there is high inflation, which will reduces the purchasing power of money and making everyday items more expensive. And in the role of monetary policy in this area will be the central bank will uses the tools like interest rate and money supply controls to keep inflation to a manageable level. And then, for example, if an inflation level is too high, then the central bank will may raise the interest rate to make more borrowings more expensive, and which can reduces the spending and slow down the price increases. So next is promoting economic growth. So promoting economic growth refers to the increase in the production of goods and services in an economy. It's an important area for improving the living standards and creating job. The role of monetary policy in this area is during the period of slow economic growth, the central bank can lower the interest rate, and this makes the loans cheaper and encouraging businesses to invest new projects and can they expand their areas. And this boost in spending helps to stimulate the economy and promote growth. For example, but during a recession period, the central bank might lower the interest rate. So the lower interest rates makes the borrowings cheaper and savings less attractive, and encouraging the businesses and consumers to spend and invest more and boosting economic growth. So Next is stabilizing the currency. So currency stability means maintaining a stable values for the country's money. And here, this stability is very crucial for the international trade and investment because it reduces the uncertainty. So the role of monetary policy in this area might be the central bank can intervene in foreign exchange markets or adjust interest rates to influence the currency's value. A stable currency will help the trade and investment decisions more predictable and less risky. So here, for example, if a country's currency is losing the value too quickly, then the central bank might raise the interest rate to attract the foreign investments and increasing demand for the currency and helping to stabilize its values. So, and the last one, and the next is reducing unemployment and the next one, fourth one is unemployment, reducing unemployment, and unemployment refers to the number of people actively seeking works but unable to find jobs. And high unemployment can lead to economic and social challenges. So the role of monetary policy in this area might by stimulating the economic activity through lower interest rate or other measures, the central bank can help to create jobs. And when business expands and invest, they often hire more workers, reducing unemployment. For example, um, by adjusting interest rate, the central bank can influence the level of economic activity, and the lower rates can help to reduce the unemployment by encouraging companies to borrow, expand, and hire more workers. And the last one is regulating the money supply. And the money supply is the total amount of money unavailable in the economy, and it affects how much people and businesses can spend and invest. And so the role of monetary policy in this area might the central bank controls the money supply to ensure there is enough money to support economic activity, but not so much it causes inflation. So for example, if the requirement for for example, if the central bank wants to if increases the money supply, it might buy government bonds, putting more money into circulations.
So, hi everyone. So today's presentation is on the topic impact of monetary policy. Like in a rapidly changing economic landscape, banks play a crucial role in shaping the financial future of a nation. Through their monetary policy decisions, they influence interest rates, inflation, and employment, ultimately affecting the overall health of the economy. So we don't know how do these decisions impact different sectors and stakeholders. So today we will delve into the effects of monetary policy on economic growth, inflation, employment, and financial markets. So let's start. So let's start with the definition of monetary policy. As well know, monetary policy is adopted by the monetary authority of a country that controls either the interest rate payable on very short-term borrowing or the money supply. The policy often targets inflation or interest rate to ensure price stability and generate trust in the currency. The monetary policy in India is carried out under the authority of the Reserve Bank of India. Ultimately, its goal is to create a healthy economy with stable prices, low unemployment, and steady growth. So, come to the objectives of monetary policy. So, the objective is to maintain price stability while keeping in mind the objective of growth, as price stability is a necessary precondition for sustainable economic growth. In India, the RBI plays an important role in controlling inflation through the consultation process regarding inflation targeting. Current inflation targeting framework in India is flexible. That is, it can be changed. It is mutable. So, in order to achieve these objectives, the RBI uses various monetary tools, policy tools such as reverse repo rate, cash reserve ratio (CRR), statutory liquidity ratio (SLR), open market operations, and open market operations. So, by using these tools, the RBI influences the money supply, interest rates, and credit availability in the economy, ultimately promoting economic growth, stability, and development. So, let's come to the first one is impact on interest rate. An increase in interest rate can make borrowing more expensive for individuals and businesses. This can lead to a decrease in consumer spending and a slowdown in business investment, which can negatively impact economic growth. Conversely, a decrease in the interest rate can make borrowing cheaper, increase consumer spending and business investment, and stimulate economic growth. The next one is impact on the housing market. Higher interest rates can make it more expensive for people to borrow money to buy a house, potentially leading to a decrease in the demand for housing and house prices. Lower interest rate can make it cheaper to borrow money to buy a house, increasing the demand for housing and house prices. So it is basically the impacts on the interest rates, like when the interest rate gets high and low. Also on the housing markets, when the demand for a house increases and the cost of the house increases. The next one is impact on the stock market. Monetary policy can also impact the stock market. Lowering interest rates can make it cheaper for companies to borrow money to invest in their business, boosting stock prices. Conversely, raising interest rates can make it more expensive for companies to borrow money, leading to a decrease in stock prices. The next one is impact on exports. A contractionary monetary policy can lead to a stronger domestic currency, making exports more expensive for foreign buyers and hurting the country's exports and trade balance. An expansionary monetary policy can lead to a weaker domestic currency, making exports cheaper for foreign buyers, which can boost the country's exports and trade balance. And the last one is impact on consumer prices. Monetary policy can also impact consumer prices. For example, if the central bank raises interest rates to combat inflation, this can decrease consumer spending and consumer prices. Conversely, if the central bank lowers interest rates to stimulate economic growth, this can lead to an increase in consumer spending and an increase in consumer prices. So let's conclude the impact of monetary policy. Monetary policy can radically alter the money supply with serious impacts on the economy. For small changes in money supply, adding and subtracting with open market operations are favored. For large changes in money supply, multiplying and dividing it by changing the reserve requirement may be necessary. When banks are not loaning money, even when they are legally allowed to, the Fed will lower the discount rate. It increases the bank's profit margins and encourage them to loan more, give loan more. So that's it about the impact of monetary policy. Thank you.
So, good morning. I'm going to speak on exchange rate policies. Exchange rate policies are crucial for managing a country's currency value and its impact on trade, investment, and economic stability. So, let's get more into it. And the topic is currency peg. And the definition of currency peg, a currency peg fixes a country's currency to another major currency or a basket of currencies. So, it matches to the currency of another major country. Mechanism. The central bank sets a fixed charge, fixed exchange rate, and uses foreign exchange reserves to buy or sell domestic currency to maintain stability. Example, Saudi Arabia pegs its real to the US dollar, while Hong Kong pegs its dollar to the US dollar. So, mainly, most of the countries use US dollar as a major currency peg, as US dollar is globally accepted. And the advantages of a currency peg, stability in trade. So when two countries are having a trade, this helps in easy trading as both can trade with same currency, and this reduces your foreign exchange transaction problems. And a stable exchange trade reduces currency risk, fostering confidence in international trade and investment. Inflation control. Pegging to a stable currency can help control inflation, particularly in economics with historically high inflation. Disadvantages of a currency peg: loss of monetary policy independence, and the country sacrifices control over its monetary policy to maintain the peg, even if domestic economic conditions suggest a better, different policy. So, when you're focusing on your currency being matched to another currency, you are differing from your existing country's monetary policy. And the another disadvantage is vulnerability to speculative attacks. If market participants believe the peg is unsustainable, they may speculate against the currency, leading to a depletion of foreign reserves and potential economic crisis. So there can be speculation such that our home currency is going to fall in exchange to the pegged matched currency. So this can be against the currency that you are actually staying in. Then crawling peg. So what is the definition? What do you mean by the word crawling peg? A crawling peg is a type of fixed exchange rate system where the currency's value is adjusted periodically at a set rate or in response to certain indicators. Okay, so mm, it is similar to the peg, but it is not 100% set to match on the country. It is set on basic adjustments or for a particular period of time. The mechanism, the exchange rate is adjusted at regular intervals or when certain economic conditions are met, such as inflation or trade deficits. So the example, Brazilian child have used crawling peg system in the past to manage inflation and maintain competitiveness. So they don't use it always, only for certain conditions to meet certain conditions or certain events. And you have your advantages of crawling peg: controlled flexibility and inflation management. Controlled flexibility means the crawling peg provides a balance between stability and flexibility, allowing gradual adjustments to exchange rate without causing sudden economic shock. So you're not following the pegged currency always. So it is only for a period of time. So it helps in control flexibility that you can follow, you cannot follow. It gives you such an option. And inflation management. By gradually adjusting the exchange rate, a country can manage inflation and avoid sharp adjustments that might be necessary under a fixed peg system. Then you have your disadvantages of a crawling peg: complexity in management and potential for misalignment. Complexity in management means that managing a crawling peg requires continuous monitoring of the economy and timely interventions, making it more complex than a simple fixed or floating system. So when you're simply fixing a peg, you just fix and you leave it. But this is not the case over here. Crawling peg means you have to monitor it often. Like, is it bad? Is it time to stop following them? Is it time to follow them? So you have to keep an eye on the market always. And potential for misalignment: if the adjustments are not timely or sufficient, the currency may be overvalued or undervalued, leading to trade imbalance and economic instability. So basically, what they're saying is the currency may be overvalued or undervalued. The matching currency, it can be overvalued or undervalued, which may lead to economic instability for our currency, for our home currency. Hybrid system. So this is the last portion. It means that hybrid system combine elements of both fixed and floating exchange system, allowing for some degree of flexibility while providing certain level of stability. So it is a mix of both. And hybrid, as the name suggests, is a mix of fixed and floating. So it gives you flexibility as well as stability. And types: hybrid system includes currency boards, dual exchange rate system, and managed floats. Example: Hong Kong operates a currency board system, while Singapore and China use managed float system. Thank you.
Morning all, my name is Matthew Michael and I am going to talk about the types of exchange rate policies. First one is the introduction to exchange rate policies, and its definition is like an exchange rate policy is a set of guidelines and actions taken by country's government or central bank to manage the value of its national currency in relation to other currencies. The policy is crucial because the exchange rate affects a country's international trade, investment flows, inflation, and economic stability. And about the importance, the exchange rate impacts the price of imports and exports, influencing a country's trade balance. It affects inflation rates as changes in the exchange rate can alter the prices of goods and services. And the policy can either attract or deter foreign investments depending on the stability and predictability of the exchange rate. It's essential for maintaining economic stability, particularly in a globalized economy where countries are interconnected through trades and finance. And now I'm going to talk about the different types of exchange rates. And first one is fixed exchange rates. And a fixed exchange rate, also known as a pegged exchange rate, is a system where a country's currency value is tied or pegged to another major currency, such as US dollar or basket of currencies. The central bank commits to maintaining the currency's value within a narrow range relative to pegged currency. And about the mechanisms, mainly there are three types. First one is central bank intervention. The central bank activities buys and sells its own currency on foreign exchange market to maintain the fixed exchange rate. And the second one is foreign reserves. It is to maintain the peg. The central bank holds large reserves of foreign currencies. If the domestic currency weakens, the central bank uses the reserves to buy back its currency, reducing the supply and increasing its value. And the third one is interest rates. The central bank may also adjust interest rates to influence the capital flows, supporting the fixed exchange rates. And now let us look at two examples. First one is Hong Kong. The Hong Kong dollar is pegged to the US dollar, maintaining a fixed rate around 7.8 Hong Kong dollar per USD. Saudi Arabia, the Saudi Arabia Riyal is pegged to US dollar at a fixed rate of 3.75 Saudi Riyal per USD. And talking about the advantages of fixed exchange rate policies, like its stability, inflation control. Stability provides stability in international prices, which is beneficial for trade and investments. Inflation controls helps keep inflation in check, as it ties domestic currency to a stable foreign currency. And now about the disadvantages. Loss of monetary policy control limits the central bank's ability to use monetary policy independently to address domestic economic issues. And now the second one, floating exchange rates. And the definition is, in a floating exchange rate system, the value of country's currency is determined by market forces, especially the supply and demand for that currency in the foreign exchange market. Unlike a fixed exchange rate, there is no official target or rates set by the government or central bank. And about the mechanisms, it's market driven. Currency values fluctuate freely based on trading in the forex markets. Factors such as trade balances, inflation rates, interest rates, and economic performances influence currency values. And the minimal central bank intervention. The central bank may intervene occasionally to prevent excessive volatility, but generally the exchange rate is left to the market. For example, the US dollar operates under a floating exchange rate system, and Japan also. The Japan yen is another example for a currency with a floating exchange rate. And about the advantages of floating exchange rate is that the central bank can focus on domestic economic goals, such as controlling inflation without the constraints of maintaining fixed exchange rates, and the exchange rates automatically adjust to reflect economic conditions, helping to correct trade imbalances. And about the disadvantages, it is volatile. The currency can be highly volatile, leading to uncertainty for international trade and investment. And another disadvantage is that it has a risk of inflation. A sharp depreciation in the currency can lead to imported inflation as the cost of foreign goods and services rise. And the next type of exchange rate is managed float. And the definition is that a managed float, also known as dirty float, is a hybrid system where the currency primarily floats according to market forces, but the central bank intervenes occasionally to stabilize or steer the currency values in a desired direction. And about the mechanisms, selective intervention, the central bank steps in to buy or sell the currency to smooth out excessive volatility or to guide currency towards a more favorable value. And intervention goals, the intervention is often aimed at achieving economic goals such as preventing excessive inflation, supporting exports, or maintaining economic stability. For example, India, the Indian rupee operates under a managed float system where the Reserve Bank of India intervenes as needed. And Singapore, the Monetary Authority of Singapore manages the Singapore dollar within an undisclosed policy band, allowing it to fluctuate within certain limits. And about the advantages, balance of stability and flexibility combines the benefits of floating rates with some of the stability of fixed rates. Then controlled volatility allows the central bank to prevent extreme fluctuations that could harm the economy. Disadvantages is that it is uncertain. Markets may be uncertain about the central bank's intervention, and uh, which leads to speculative behavior. And the next one is next disadvantage is that it requires large resources to intervene effectively. The central banks need substantial foreign exchange rates. And now to the last slide. It's choosing a policy. We can choose a policy according to two conditions, like economic conditions and policy objectives. First one is economic conditions. The choice of exchange rate policy depends on country's economic conditions, including its level of development, inflation rates, trade balance, and integration with the global economy. And about the policy objectives, countries with strong, stable economic might prefer floating rates to maintain monetary policy control, while those with more volatile economies might choose fixed or managed float systems to stabilize their currencies. And that's all about the types of exchange rate policies. Thank you.
So the topic that I've been assigned is the implication of exchange rate policy. Exchange rate policy is a crucial aspect of macroeconomic management. It affects various economic variables including inflation, trade, investment, and the performance of business. So one of the implications is economic stability, so inflation control. A stable exchange rate can help control inflation by reducing the cost of imported goods. However, depreciating currency can lead to inflation, especially in countries with higher import dependency. So example, if I would say, imagine if you want to buy a car from another country. So if your currency is strong, the car will cost you less in your local currency. Interest rate, exchange rate policy often influence interest rate. Central banks may raise interest rates to attract foreign investment and support the currency, but this can also slow down economic growth. So interest rate is basically like when you borrow a loan, you need to pay interest along with the amount. So that is what is interest rate. So sometimes government may raise interest rate to make their currency stronger. So this will attract the foreign investors to invest the money, and they'll have higher return on their money. So but higher interest rate can also slow down the economy. So think of it as people being less willing to spend money. Next is employment. Weaker currency can boost exports, potentially leading to job creation in export-oriented industries. So strong currency can make exports more expensive. This might be harder for the businessmen to sell things to other countries, which could create job losses. On the other hand, weaker currency can make exports cheaper. This might help businesses sell more and create job more. Next implication is trade balances. We've got export and import. Exchange rate policy influences the price competitiveness of goods and services. And depreciated currency makes exports cheaper and import more expensive, potentially improving the trade balances. So think of it as buying and selling. So export means selling of goods to another country, and import means buying a good from another country. So a weak currency can make your exports cheaper. So this can help you sell more to another country. A strong currency can make your imports cheaper. This can help to buy things from another country at a lower price. Competitiveness. A weaker currency can enhance international competitiveness by making goods and services more attractive abroad. A stronger currency can make them less competitive, particularly for export-oriented economies. So competitiveness is like how well you can compete with other countries. So weak currency can make your products more competitive because they're cheaper. A strong currency can make your product less competitive. This means other country might sell their product cheaper. Trade deficit and surplus. Exchange rate policy can either exacerbate or mitigate trade deficits and surpluses. Countries with persistent trade deficit might use devaluation to try and narrow the deficit by boosting exports and reducing imports. So a trade deficit is like when you buy more from other countries than you sell. So trade surplus is when you sell more to other country than you buy. So weak currency can help reduce a trade deficit. This is because it makes your exports cheaper and imports more expensive. Next, implications for investment. Attractiveness. A stable and predictable exchange rate attracts foreign investors by reducing currency fluctuations risk. Conversely, volatile exchange rates can deter investment due to uncertainty. So foreign investment is when people from other country invest in a country. So a stable currency makes your country more attractive to foreign investors. They feel like safer to invest their money, and they know that that currency won't change much. Capital flows. Exchange rate policies can impact capital flows. Higher interest rate to support the currency may attract short-term capital inflows, but they can also lead to sudden outflows if investors perceive devaluation risk. So capital flows are the movement of money in and out of the country. So high interest rate can attract foreign investors. This means that more money is being flown into the country. However, if investors think the currency might get weaker, they might quickly take their money out. Exchange rate risk. Unstable exchange rate expose businesses and investors to exchange rate risk, which may lead to financial losses. Investors might demand higher returns to compensate for this loss, increasing the cost of capital. Exchange rate risk is a risk. Exchange rate risk is a risk that the value of the currency will change. So this affects the businesses that deal with other currencies. If the currency gets weaker, businesses might lose their money. So next we'll be talking about how these implications impact on multinational corporations. Revenue. MNCs operating in multiple countries are affected by exchange rate fluctuations. A stronger home currency can reduce the value of overseas earning when converted back, impacting profitability. So MNCs are the ones who sell goods to other countries. So if the currency gets stronger, the money earned in other country is worth less in their home currency. Profit margin. Exchange rate fluctuation can affect input cost and product pricing. MNCs might face squeezed profit margins if production costs increase due to a weaker local currency, or if they can't raise prices accordingly. So profit margin is the difference between how much the company earns and how much it spends. So if a currency gets weaker, it can cost more to make a product. This will automatically reduce the profit margins. Hedging. MNCs often use financial instruments like futures, options, and swaps to mitigate exchange rate risk. However, exchange rate risk is costly and they might not eliminate all risk. So hedging is a way or tool to protect yourself from losses. MNCs use such financial tools to mitigate or reduce risk that is happening in an exchange rate. Next is how these implications impact on domestic businesses. Cost of imports. Business reliant on imported goods and raw materials are affected by exchange rates changes. A weaker domestic currency makes imports more expensive, increasing production cost. So imports are things which business need to make products. So if the currency gets weaker, it can cost more to import inputs. So This can increase the cost of making the product. So that is one of the impact of domestic businesses. Pricing strategy. Business may need to adjust pricing strategies in response to exchange rate movement, and depreciated currency might lead to price increases to cover high import cost, potentially reducing demand. So businesses might need to raise prices if the cost of making products goes up. But if if they raise prices too much, people might buy less. Competitiveness. Domestic businesses competing with foreign firms face competitive issues. A strong domestic currency can make foreign goods cheaper. So a weak currency can make domestic businesses more competitive. This is because the products are cheaper. So if a strong currency makes domestic business less competitive, this is because their products are more expensive. So the last topic is about government debt and currency crisis. Debt repayment. Countries with significant foreign debt are vulnerable to exchange rate fluctuations, and depreciated local currency increases the cost of repaying foreign denominated debt, straining government finances. So debt is like a country when borrows money from other country, it has to pay it back. So if a country currency gets weaker, it costs more to pay back the debt. Currency crisis. Poorly managing exchange rate policies can lead to currency crisis, characterized by rapid and uncontrollable currency depreciation. This can result from a loss of confidence in the economy, speculative attacks, or unsustainable policies. So our currency crisis is when a currency loses its value very quickly. So this can happen if people lose confidence in the economy. Sovereign credit rating. A sovereign credit rating is a measure of how likely a country is to repay its debt. So stable currency can help a country get better credit rating. So they're willing to loan out the amount based on the credit rating. This means that it can borrow money at a lower interest rate also. So thank you.